Well, if China was looking to jolt the global markets, it certainly succeeded. In a surprise move, the world's second largest economy devalued its currency by nearly 2% against the U.S. dollar, its largest devaluation in 20 years. A weaker yuan would make China's goods more affordable to foreign buyers. So the move is being widely interpreted as an indication China's economy is in danger of a deeper slowdown. Those concerns sent stocks tumbling. The Dow Jones Industrial Average fell 212 points to 17,402. The Nasdaq dropped 65, and the S&P 500 sank 20. Commodities also came under pressure since China is a big buyer of them. Oil fell to a 6-year low, down 4% to 43.08. Crude was also pressured by a report from OPEC that showed output increased to a 3-year high in July. And it's not just stocks and commodities that are reeling. The impact could be wide-reaching. It was a shot literally heard around the world. On a down day, China's devaluation of the yuan is the anchor that dragged down stocks, bond yields, and commodities markets around the world.
I think it's screaming that China is in trouble. I mean, we've seen a series of data points out of China of serious slowdown.
Factory output is weak. Low inflation is making it harder for Chinese companies to pay off debt. And the government has been cutting interest rates while trying to fend off a stock market collapse. Now, devaluing its currency means Chinese exports are cheaper to buy. But the reverse is also true. Goods imported into China, especially commodities like oil and metals like copper used to make things, are more expensive. Companies sure to be impacted include Yum Brands, which owns Kentucky Fried Chicken, Johnson & Johnson, and Apple. All rely heavily on sales in China, but a weaker yuan means less revenue when their sales are converted back into U.S. dollars. Apple saw sales in Greater China, including Hong Kong and Taiwan, surge 112% in its most recent quarter. Overall, it does 27% of its business there. The lower yuan caused Jefferies to lower its target on Apple today by $5 to $130 per share. 17 of the top 20 S&P 500 companies with the highest sales exposure in China are tech. The biggest are Intel, which does 36% of its sales there, Qualcomm, which does more than 60%, and Texas Instruments with 44%. Overall, though, the S&P 500 has only 2% of its sales at risk in China, which leads to an interesting debate: just how much the lowered yuan will influence the U.S. Federal Reserve. Some believe it will be a big factor.
I think they're going to hold. I think this makes it, much more likely they're going to hold.
Others, not so much.
I don't think the Federal Reserve will back away from tightening just because of this one event, although there's lots else that could happen between now and the middle of September.
I don't think it really changes the equation. The Fed will be making monetary policy on the basis of U.S. conditions and because of U.S. policy needs.
So the real question may be just how much devalued yuan will affect the U.S. economy. And today, the U.S. Treasury said it's too early to judge the implications of China's currency devaluation, but the department said that it will continue to press China to move towards a market-oriented exchange rate and that any reversal from that would be troubling.